Well, welcome to the debate. Today we're dissecting a transition that virtually every single investor faces, yet statistically speaking, almost nobody prepares for it correctly. We spend 20, maybe 30 years completely obsessed with the accumulation phase. It is the standard playbook. We buy assets, we dollar cost average, we basically pray for growth. It is all about making the pile bigger.
Right, it is the mountain climb. You're just looking up at the summit, putting one foot in front of the other, just trying to get there.
Exactly. But there is a second phase, the decumulation phase. This is coming down the mountain. And the source material we're looking at today makes a pretty chilling point about this. The mathematics of money fundamentally change the exact moment you stop adding to the pile and start subtracting from it. The strategies that made you rich during accumulation, specifically aggressive exposure to equities, can actually ruin you during decumulation.
And that change is violent. We aren't just talking about having a bad year in the market. We're looking specifically at the danger of remaining 100% invested in equities, specifically ETFs, when you are approaching a major financial goal or retirement. The conventional wisdom is always time in the market beats time in the market. We hear it every single day. But as we will discuss, that maxim might actually destroy your financial future if you apply it at the wrong moment.
Which brings us to the core question we are debating today. Is the strategy of remaining fully invested in the market fundamentally reckless when you're about to start withdrawing funds? I argue that it absolutely is. I believe that sequence of returns risk is the single greatest threat to a retiree, and failing to de-risk, failing to sell high and buy safety is a catastrophic error.
And I am coming at this from the complete opposite side. While I agree the risk is real, I believe that swinging too far into safety, moving heavily into cash and bonds, creates a guaranteed loss against inflation and longevity. You might avoid a market crash, sure, but you invite a slow death of purchasing power. The question isn't just about safety today, it is about ensuring you do not outlive your money 20 or 30 years from now.
Well, let's establish the stakes here. I want to start with my position on what the source calls the phase shift. If you look at financial media, 99% of the content out there is about accumulation. When you are building wealth, volatility is your friend. If the market drops 30%, you are buying cheap. You are acquiring more units. It's a sale. You celebrate it because you are a net buyer.
Sure, because you have an income, you aren't touching the principal, you are actively adding to it.
Precisely. But the moment you switch to decumulation, to actually spending that wealth, volatility transforms from an opportunity into a predator. This brings us to the concept of critical capital, which is really the crux of my argument today.
Define that for us, because it sounds a bit technical.
It is actually very practical. Imagine you are 30 years old. You have 100,000 euros invested. The market crashes 30%. You're down to 70,000. Is it annoying? Absolutely. Is it fatal? No. You have human capital, you can work, you can save, and most importantly, you have 30 years for the market to recover. The capital is reproducible. You can literally make it again through your own labor.
Correct. Time heals the wound because your prime wage earning years are still ahead of you.
Now fast forward. You are 62 years old. You have 1 million euros. This is your life's work. The market crashes 30%. You have just lost 300,000 euros. You cannot simply work harder to replace 300,000 euros at age 62. You don't have another 30-year horizon. That capital has become critical. It is non-reproducible. At this stage, the goal shifts entirely. It is no longer about maximizing the hope of returns. It is about minimizing the risk of ruin. If you treat your retirement portfolio like your growth portfolio, you are behaving irrationally because the consequences of loss are no longer symmetrical.
Look, I see why you frame it that way. And critical capital is a strong concept, I will give you that. It makes intuitive sense that the utility of money changes as you age. But let me offer a counter perspective based on the material. You are focusing intensely on the risk of a market crash. That is a visible, dramatic event. I am looking at the risk of erosion, which is invisible. A retirement today can last 25 to 30 years. If you retire at 62, there is a very decent probability you live to 90 or 95.
We should all be so lucky.
Indeed we should. But that means your portfolio isn't just a static savings account that you draw down. It is an engine. And that engine needs to outpace inflation for 3 solid decades if you move heavily into cash or bonds. What the source calls tools of consumption, you are actively detaching yourself from the tools of wealth creation, which are stocks. If you de-risk too aggressively because you are terrified of a 30% drop, you might find yourself at age 80 with a portfolio that has been safe, steady, and completely devoured by the cost of living.
But that assumes you need maximum growth to survive, which you don't.
It assumes you need significant growth. And there's another layer here, the market timing trap. The source material highlights this explicitly. Strategies that involve selling out of the market to secure funds often look suspiciously like market timing. If a retiree sits in cash waiting for a crash that doesn't happen for 5 years, they miss the massive compound growth that was absolutely necessary to fund their later years. That opportunity cost is just as damaging as a crash. It is just less psychologically painful in the moment because you don't see the loss on a monthly statement, but the loss is real.
I strongly disagree that it is market timing. It is liability matching. But let's get into the actual mechanics of why I believe the crash risk is mathematically superior to the inflation risk. We really need to drill down into the mathematics of sequence of returns risk.
Let's break it down, yeah? Because people hear sequence risk and their eyes immediately glaze over. But it is actually the most important math a retiree will ever do.
It really is. The source uses this brilliant analogy, the frozen lake. Imagine you have to cross a frozen lake to get to your destination. You are told the ice is on average 1 meter thick. That sounds incredibly safe, right? I mean, you can drive a commercial truck over 1 meter of ice.
On average, yes. Statistically speaking, it's a fortress.
Exactly. But average does not matter at all if the ice is 5 millimeters thick at the very distinct point where you take your first step. If you fall through at the start, you die. It doesn't matter if the ice is 3 meters thick in the middle of the lake, you are already dead. This is sequence of returns risk. In investing, we are completely obsessed with average returns, that historical 7 or 8% per year. But if you get your bad returns at the very start of your retirement, you drown. The average doesn't save you.
I accept the analogy, but I would argue that the death isn't as instant as falling through ice. You can adjust your behavior. You aren't literally underwater the moment the market dips.
Can you, though? Let's look at the hard math from the text. This is the concept of negative convexity. Let's take that €1 million portfolio again. You retire, the market drops 30% immediately. You have 700,000 left, but you still need to eat, pay your bills, and live. So you withdraw 40,000 that year for living expenses. Now you are down to 660,000.
Right. You have taken a hit from the market and a hit from your own withdrawal.
And here is the trap. To get back to your original 1 million, you don't need a 43% return, which is the standard recovery from a 30% drop. Because you withdrew capital, you dug the hole deeper. You now need a 51% return just to get back to square one. The withdrawal amplifies the loss. The math works against you with brutal efficiency. If the market stays flat or drops further the next year, you enter a death spiral. You are literally eating your own seed corn.
That is a very compelling argument mathematically. Negative convexity is a real beast. I don't deny that. But have you considered that the thin ice might not be at the start? You're building an entire massive strategy based on a worst-case scenario occurring on day one. What if the market rallies for 10 years? If the market crashes 30% 10 years into retirement, the math is completely different because your portfolio might have grown to 1.5 million by then. A 30% drop then just takes you back to where you started.
But you cannot possibly know when the crash will come. That is the entire point. It is a known unknown. If you stay fully invested, you are betting your literal survival on a coin flip.
True. But by acting as if the crash is inevitable at the start, you are paying an insurance premium that might be way too expensive. Average returns do still matter because they dictate the longevity of the portfolio over that entire 30-year span. If you flatten your returns to avoid the day 1 crash, you might run out of money on day 7,000 regardless of the sequence. You are trading a risk of sudden death for a certainty of malnutrition.
That is exactly why we don't go to zero equities. It is not binary. But we absolutely must use airbag strategies. The source material offers concrete solutions that I feel you're dismissing way too lightly. We aren't talking about stuffing money under a mattress for 30 years. We are talking about bond tents and bucket strategies. These are specific tools designed to handle this exact transition.
Walk us through the bond tent then, because I have serious reservations about its complexity for the average person. It sounds like something an institutional trader does, not a regular person with a standard pension.
It is actually quite intuitive. The danger zone, the thin ice we talked about, is a few years just before and just after retirement. That is when the portfolio is at its largest and the time to recover is at its shortest. So you build a tent. Leading up to retirement, you aggressively increase your allocation to bonds. That forms the point of the tent to reduce volatility.
So you glide from, say, 80% stocks down to 50 or 40% right at the date of retirement?
Exactly. You reduce the risk when the risk is mathematically highest. Then, once you are safely through that transition phase, say 5 years into retirement without a major crash, you slowly spend down the bonds or reallocate back to stocks. The equity allocation actually goes up later in retirement. It creates a temporary shield during the most critical period. You deploy the airbag only when you are driving through the most dangerous intersection.
It sounds great in theory, but practically speaking, it requires absolutely perfect timing and execution. You are essentially betting that the crash will happen inside the tent. What if the market rallies 25% while you're building this tent? You are sitting in fixed income, just watching your future purchasing power evaporate. The source mentions the psychological pain of FOMO, the fear of missing out. It is very real. An investor might abandon the plan halfway through because they feel like they are losing out on massive gains.
I argue it is much better to suffer FOMO than total ruin. Missing out on a gain is annoying. Running out of money at age 80 is a tragedy. Those are two fundamentally different types of pain.
Fair point. But let's look at the implementation. The bond tent requires active, disciplined management. Most people just want to buy the market and forget it. If they mess up the timing of the tent, they could easily do more harm than good.
Then let's talk about the simpler strategy outlined in the text, the bucket method. You keep, say, 2 to 3 years of living expenses in absolute cash or monetary funds. This is your buffer. If the market crashes, you don't sell a single share of stock. You spend the cash bucket. You let the equity market recover. It just buys you time.
I have to say, I just don't buy that the bucket strategy is a failsafe. It's incredibly popular, I know, but look at the historical data. Bear markets can last significantly longer than 2 years. The dot-com crash, the global financial crisis, the recovery times can be brutally long. If you burn through your 2-year cash bucket and the market is still down, you are right back where you started. You are forced to sell stocks at a loss anyway.
But you are selling less at a loss than if you had no bucket at all. It mitigates the damage. It prevents you from selling the whole farm at the absolute bottom.
Mitigates, yes. Cures, absolutely not. And there is a massive cost to that bucket. Cash is a depreciating asset in real terms. Holding large amounts of cash, let's say 100,000 euros, just sitting there doing nothing, is a guaranteed loss of value over time due to inflation. You are trading a probabilistic risk of a market crash for a deterministic loss to inflation. You are basically agreeing to lose money slowly just to avoid losing it quickly.
I would argue that for specific goals, deterministic loss is perfectly acceptable if it guarantees liquidity. We really need to distinguish between indefinite retirement and fixed goals here. The source brings up a crucial distinction regarding real estate that clarifies this perfectly.
Real estate is a completely different animal. I will agree with you there.
Completely different. If you are planning to buy an apartment in 18 months and you need 200,000 euros for the deposit, staying 100% in ETFs is not investing. It is gambling.
I concede that point. That is a short-term liability.
The source puts it perfectly. The market doesn't care about your notary appointment. Imagine you are ready to sign. The notary is waiting. The market drops 30%. Your 200,000 is now 140,000. The seller isn't going to wait 3 years for the S&P 500 to recover. They don't care about your average returns.
The deal is dead. For fixed liabilities with hard deadlines, volatility is entirely unacceptable.
I agree entirely on the real estate example because it is a binary event. You sign the paper or you don't. It happens on a single, specific day. But this is exactly where I think your argument regarding retirement gets into serious trouble. Retirement is not a house purchase.
How so? It is a liability you absolutely must fund. It's a bill that comes due every single month.
But it is not a liability you pay off on a random Tuesday. You are not cashing out at age 62. You are starting a brand new business called income generation. That business needs to run continuously for 30 years. If you treat retirement like a house purchase, meaning you go to cash to secure the price, you are liquidating the inventory of your business. You are shutting down the factory, the stocks, that produces the product, the returns. You are conflating a point-in-time goal, like buying a house, with a duration goal, like living for decades.
I am not suggesting going 100% cash for 30 years. I am saying you cannot be 100% equities at the start of that duration goal. It really comes down to psychology versus rationality. The best strategy is the one you can actually hold. You can talk about the 30-year horizon all you want, but if a retiree sees their account drop from $1 million to $580,000, which happens if you combine a 30% drop with withdrawals, they will panic. They will sell at the bottom.
That is true. Panic is the ultimate destroyer of wealth. We saw it in 2008, we saw it in 2020. People sold exactly when they should have been holding on for dear life.
Exactly. My conservative approach, the bond tent, the buckets, it prevents that panic. It provides a psychological anchor. Even if it is mathematically suboptimal, in a raging bull market, it is optimal in the real world because it keeps the investor in the game. It stops them from jumping off the boat in the middle of a hurricane.
That is a strong point. The behavioral aspect simply cannot be ignored. A suboptimal plan you actually stick to is far better than an optimal plan you abandon in terror. However, the secure approach requires an entirely different kind of psychological fortitude.
What do you mean by that?
It requires the ability to accept underperformance. The human brain is conditioned for 30 years of accumulation to maximize everything. We get dopamine from seeing the number go up. Your strategy asks the investor to actively suppress that fundamental instinct, to watch the market roar ahead by 20% and be content with 4% because they are safe. That is a very difficult psychological pivot. You are asking someone to voluntarily become poorer relative to their peers for the sake of safety.
It is difficult, but it is necessary. It is the maturity of recognizing that the rules of the game have changed. You aren't playing for high scores anymore. You are playing for extra lives.
I just question if the average investor can execute a bond tenth correctly, though. The source mentions that becoming prudent too soon, say 5 years before retirement, can be incredibly dangerous because you sit in depreciating assets while the market rallies. The complexity of managing a glide path of asset allocation is very high. Is it not simpler to just adjust the withdrawal rate?
Adjust it how? Practically.
Instead of selling bonds, just spend less when the market is down. Variable withdrawal rates. If the market is down 20%, you cut your vacation, you delay buying the new car, you tighten the belt. You preserve the capital by simply reducing the demand on it. You flex your spending, not your portfolio.
Spend less is very easy to say, but incredibly hard to do. Many retirement costs are totally fixed. Healthcare, housing, insurance, basic food. You can't just decide to cut your budget by 40% because the NASDAQ is having a bad quarter. That puts the entire burden of volatility directly onto your lifestyle rather than on your portfolio. That is extremely stressful living. That is precisely why the portfolio structure must provide the flexibility, not just a household budget. You do not want your quality of life to oscillate wildly with the Dow Jones.
I suppose that brings us back to the fundamental definition of risk here. You see risk as the volatility of the portfolio. I see risk as the rigidity of the plan. If your plan requires 100% safety to work, it is fragile. If your plan requires 100% equity growth to work, it is reckless.
Then we agree that 100% equity at the exact moment of transition is reckless.
I would say it is highly aggressive, perhaps overly so for most people, but not necessarily reckless if the withdrawal rate is low enough. If you only need to withdraw 2% of your portfolio, you can weather a storm even in 100% equities. But for the average person needing 4 or 5%, yes, 100% equities is walking on very thin ice.
And most people are absolutely in that 4% category. They need the money to live. They are crossing the lake. And if they fall through, there is no second chance.
But let's look at the nuance the source provided regarding the slow death. The source warns clearly that becoming too prudent too soon creates a scenario where you hold assets that simply don't keep up with the cost of life. The critical capital concept works both ways. Yes, you can lose capital to a crash, but you can also lose the actual purchasing value of that capital to inflation. If you hold only bonds and cash, and inflation hits 5% for 3 years, you have lost 15% of your purchasing power without the stock market ever crashing once.
Which is exactly why the source suggests a balanced approach, not a binary one. We aren't arguing for 100% cash here. We are arguing against 100% stocks. The bond 10 implies you eventually go back into stocks. You just don't stand naked in the storm during the most vulnerable transition phase.
I think that is the key distinction. It is about the transition itself. The accumulation mindset is maximize. The decumulation mindset is, well, it's a lot more complicated. It is survive first, then thrive.
I would frame it as return of capital becoming vastly more important than return on capital. When you are young, you can afford to lose money because you can always make more. When you are old, your money is your lifeblood. You cannot afford to lose it to a bad sequence of returns. Freedom ultimately is not depending on the market for your life's basic projects.
And yet, unless you are incredibly wealthy, you do depend on the market. That is the paradox of retirement. You need the market's engine to fund a 30-year life, but you cannot afford the market's volatility in year one.
So where do we land on this? Because we need to give listeners a concrete takeaway from the material.
Is a highly misleading metric for retirees. It's a lie of averages. The order of those returns is what actually dictates whether you die rich or broke.
Precisely. And the source's final sentiment is one I think we can definitely both align on. The stock market is a tool for wealth creation. Cash is a tool for consumption. The true art of retirement planning is simply knowing when to switch tools. If you try to consume your wealth creation tool, meaning selling stocks when they are down, you break the machine.
And if you try to create wealth with your consumption tool by holding cash for 30 years, you starve the machine. It really is an incredibly delicate balance.
It is. The takeaway for our listeners should be to sit down and calculate their own critical capital point. Identify that exact moment when your money becomes non-reproducible.
And once you identify that moment, do not let the rigid dogma of buy and hold blind you to the very real math of sell and survive.
Well said. That brings us to the end of this debate. It is a highly complex transition, but one that can be managed if you have the right airbags in place.
Indeed, don't fall through the ice.
Thank you for listening to The Debate.